An inflation surprise in the UK today, but this time it's a good one. Good morning everyone and welcome back to Morning Markets. So it's very much been a beginning of the year where bonds are in control. That is, yields are rising. Since the US Federal Reserve delivered its first rate cut back in September, yields on a US Treasury 10-year bond have risen by over 100 basis points. For holders of those bonds, that's a capital loss of around about 7.5% in a little over 3 months. Yields here in the UK on gilts issued by our Treasury have risen by a similar amount. And German bunds, they've risen by about 52 basis points, only around half of the rise we've seen in the UK and the US. But the message to take from this is the UK bond market is behaving very similar to the US, but we don't have the same economic growth as we do in the US. GDP growth for 2024 in the US is likely to be confirmed around 3%, whereas in the UK it's probably going to come in closer to 1%. And in fact, over the 6 months to October, GDP in the UK was actually only 0.2. So the summary here is the UK faces a number of challenges despite having bond yields similar to the US. We have very weak growth and we have structurally sticky prices. And that's confirmed somewhat by the CPI data which came out this morning. Despite it being a bit lower than market consensus at 2.5% versus 2.6% expected, inflation is still set to continue to rise. Now this is largely in line with expectations, but it's still a rise in already sticky inflation pressures at a time when the UK economy is struggling, and we know there are further price rises ahead for businesses. That is the national insurance rise and the increase to the national living wage, which is coming through in April. So what can government do? Well, not a lot, because at the moment it really is an international phenomenon. That is, bond yields are rising because markets are preparing themselves for the second wave for inflation, but this time it will be a much smaller wave. If we think of a pebble falling into a pond, the first ripple is the largest, and that's what we saw back in 2021 and 2022. But we're likely to see a second smaller wave of inflation, which has been coming through for the last quarter or two. And data from the US yesterday confirms the same for the economy there. Core inflation, that's the preferred measure for the US Federal Reserve, is likely to increase towards 3% for December. So it's not a UK phenomenon, sticky inflation prices. It's just that these prices are hitting us with a very weak economy already. So that's really what you'll have been reading dominating the press, which is this rise in yields is challenging the Chancellor and her fiscal forecasts, and why we're reading about extra spending restraint from government budgets for the year ahead. So in summary, a modest surprise for the UK today, CPI a little bit weaker than expected, but further price rises are coming.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.